Investing can sometimes seem like a gamble or sometimes very dull. At the so-called gambling end of the spectrum, you have shares with the possibility of rapid movements up and down in the prices from day to day. At the other end of the spectrum, there's cash at the bank, which has very little movement from day to day or month to month. Investors looking for a halfway house do have options. They can buy bonds. Bonds are somewhat of a mystery to most people because they aren't talked about all that often. But bonds can play an important part in managing your savings and investment. They provide a middle ground between the risk of shares and the routine of day-to-day cash. How do bonds work? At the most basic level, a bond is a loan. Or more technically, it is a large loan that's been split into packages and sold to investors. Bondholders make money by receiving regular payments of interest, called the coupon, over the life of the loan. When the loan ends, their original investment is returned. Bonds may have lives from 1 to 30 years. You can buy individual bonds or units in a bond fund run by an asset manager. Like shares, bonds and bond funds can usually be sold at any time, and the value of your investment might go up and down. With bonds, if you do not hold the investment until maturity, you may lose money. Bond prices usually move less than shares. That is why they are usually considered safer. The original investment and the coupons are more secure with bonds. With shares, there is no guarantee that you will receive a dividend or that your original investment will be returned. There are two types of bonds: corporate and government bonds. Corporate bonds are more risky because the company issuing the bond may go bankrupt. But in bankruptcy, bondholders are paid before shareholders. Governments rarely go bankrupt, so government bonds are safer than corporate bonds. And the interest rate you receive on government bonds is lower to reflect this. Getting more technical, there are different types of bonds to meet different financial conditions. In particular, there are index-linked bonds, which are designed to protect the coupon and the interest payment against inflation. This can be particularly important for people who wish to protect their savings against rising prices. You do not have to buy bonds. Some people are happy to invest exclusively in shares or property or leave their money in the bank. But if you want to spread your risk, diversify your investments, there is always a halfway house in bonds. Want to know more? Go to eZonomics.com. Economics made easier.